All right, welcome to Be the Market Expert. And let's kick this thing off. We're going to look at Resi Club and some analytics. And I thought this was interesting. I did post this in our Facebook group this morning. And if we were to look at this thing, this is the 1 year change in active housing inventory for sale, uh, January 2024 versus January 2025. And again, this is rear view facing data. I think that's the first thing we need to keep in mind is this was looking at last month. The second thing that I think we also have to keep in mind when we're looking at statistics, when we're talking about active inventory or even inventory that's hitting the board, is that it has to actually stay on the market long enough for it to be captured. And I think that's kind of one of the things like when we're doing and we're having these conversations of like, oh, houses were, only on the market for a couple minutes and that perception that the public had, like that's very real as far as capturing data as well. As we look at this thing, here we are. Here is Colorado, for those that did not know. And we're this dark green and 33%. We had 33% more inventory on our market in this year, right? Because we're already in 2025, last month, versus what we had in 2024. And then if we were to click on this little button right here, it's like, here's the interactive map. Let's go into this thing. So here's Colorado. I wish I could zoom. There we go. This is interesting, right? So year over year change 38.5%. We went from 12,893 to 17,850. I haven't done that math. I don't really know if that's real or not, right? But you could just divide them and we would figure it out. But what's interesting is if we look at 2019, right? Anything that we're doing when we're having conversations and we're thinking about a normal market, remember it's 2019 and before. We don't count 2020 as a normal market, 2021, 2022, 2023, and definitely not 24 or and 2025. So as we're looking at this thing, we look at 2017, we had 16, then we went down to 14, up to 17, down to 15. Here's in 2020, right? So here's the pandemic, 15,000 homes on the market in January, right before the pandemic started. 2021, 8,500. Keep in mind, interest rates super low. We're still talking about January. So when we go into 2022, this is January. So it's still super low interest rates, right? So that's why we have even less inventory on the board. And here's the thing, guys, inventory could have hit on a Saturday and come off the market on Sunday or even Monday or whatever, and it probably wouldn't have been captured. So like these are a little bit different as we look at them. Then 2023, we know that inventory went up on the second half of 2022. So we had 12,200 homes. 2024 went up a little bit more, 12,800, almost 900 homes. And then last month, a couple days ago, 17,850 homes on the market in Colorado. Because we are shifting to a buyer's market in Colorado, which honestly is a good thing, right? Like as we're looking at this thing, when we get into more of a balanced market, and I get there's pockets, right? There's absolutely pockets where we're seeing multiple offer situations. We're seeing things that where buyers are competing on homes where they're being underpriced and letting the market carrying them up. And I actually think that's a dangerous strategy in 2025, but rock and roll. So we are seeing these different things where we're seeing multiple offers, yes, in pockets, and we're seeing homes sit on the market longer in most areas. And so I think that as we're going through when we're thinking about this is why we should be reaching out to our buyers, right? There's more options than they've ever had. Now, here's the thing. If interest rates stay elevated, we'll probably see more homes hit the market. There'll probably still be more and more inventory coming on. And yes, it doesn't mean that inventory is not falling off the board, but we are seeing motivated sellers listing their homes at this point. And if interest rates stay kind of where they are, this number will probably creep back up. And there's not a whole lot of people in the camp that interest rates are going to come down anytime soon. So let's go down a little bit further. This is active housing inventory for sale compared to pre-pandemic levels. Okay, cool. So we're going to go 2019 January versus 2025. So here we go, guys. If we're looking at this, we're one of three states, right? So look at this green. We're one of three states that have more inventory today than we had in 2019. Remember, 2019, normal market. Interest rates were normal, inventory was normal, nothing weird was happening in our ecosystems. We're at 2%. So we're definitely not Texas at 13%. We're definitely not Florida at 5. And keep in mind, Florida has some things going on, right? They got weather, they have condos that are sitting on the market. They got all kinds of stuff. And when we think about what happened, especially with this digital nomad era where people were able to work from home, and we're probably going to see a lot of that come to an end here soon. This is where people were moving to, right? We were seeing people come across the panhandle. So we saw a huge influx in Texas. We saw a huge influx in Florida. And with that, and we're looking at it when we're thinking about this conversation, these two states, specifically Texas and Florida, they were building. They were like, if we build it, they will come. And so they were having these huge appreciation gains, and builders were just building and pumping out homes. I think we're going to start seeing this slow down a little bit, and yet they have more inventory today, either from resales and or new builds, and that's why their numbers are a little inflated at this point. And then we just have to keep in mind with what we have. I think it was 2024 was the first time that in a very long time that we have seen more outbound versus inbound. And when we start thinking about our price point versus Texas as a whole and Florida as a whole, we are significantly more expensive, right? So when we're going through and we're looking at this, the people that are moving in, unless they are, unicorns, right? What we're seeing is that most people moving in to Colorado, their income has to be north of $100,000, right? I think it's closer to like 140K to be able to come into and afford Colorado. So we're seeing 2%. This number could go up a little bit. I'd be interested to see kind of what happens to this 13 and this 5%, as they still are fairly inexpensive, but yet we also know we have some insurance things that they're going to start to happen. So we'll kind of see what happens with Florida, with Texas. We scroll down a little bit more, and here we are. This is just another view of that same map. Here's Texas, here's Florida, here's us. We are higher. And so this is just another visualization of this same map where we kind of see everyone else. And then we can kind of go down here and we got Connecticut. All right. So Connecticut's probably, leading the charge with less inventory. And it was kind of interesting. We did see this swing. We saw a swing from the panhandle, so the southeast of the United States, and now it's the northeast of the United States we're actually seeing more people move into. And so that's why their inventory. So kind of interesting to see this big swing that we have. Well, let's scroll down a little bit further. And I'm going to try to enlarge this a little bit, right? We're looking at 2018 through 2025, and here's 2025 versus pandemic again, January. So this is the first of the month, because obviously we can't do February, March, right, throughout this year. And here we are at number 4. And again, most of this is based off of 2025 versus 2019. Here's our 2%. But we can just see this kind of just play around. Here's Florida. And so Florida, 2018, they had 133,000 homes. Now they're at 157. We look at Texas, 82 versus 102. District of Columbia, 1,000 versus 2,000. If we're looking at 2018, again, we're going all the way back to 2018 versus this. But here's Colorado, 14.5 versus 17.8. And then obviously these big dips when money was free. And now we've just been seeing more and more outbound population, job related, interest rates, insurance, insert whatever. Here we're seeing more people leave our state versus stay in it at this point. So kind of interesting. I think that as we're going through, we're having this conversation, we at least need to get back into relationship with our buyers, figure out what is their 3-month goal, their 3-year goal, their 1-year goal, their 5-year goal, and just see what's going on, and propose the question. If you have been thinking about buying or selling or investing in real estate, what is the 1 or 2 things that you're looking for to happen before you pull the trigger? And propose that question however you want to propose it. But I think you guys would be interested to see like what people are thinking about, right? So let's shift gears, and I'm going to kind of go, well, in order but out of order. So this came out Monday. yesterday. Logan Motoshami, right? We know how I feel about housing wire information. And we're looking at this thing that says mortgage rates remain flat despite tariff drama. And there was drama, right? Like this came out 3:28 p.m. So I think most of the drama unfolded by then. But as we're going through and we're looking at this, remember tariffs, as of Friday of last week, tariffs were coming out. Canada, China, Mexico. And China's was a little bit lesser. Mexico and Canada were both had the same percentage, that 25%. And so we're going through and we're going to see a 25% tariff on Mexico, Canada, 10% on China. That was Friday. Then the weekend rolled around, still tariffs were in the air. And then Monday rolled around and there's some negotiations. So what did we see? So the US dollar shot up. It says this was expected after announcements the dollar should have risen. However, as deals were made, the dollar, which was trading around 110, gradually declined over the day. One issue with the trade wars is that strong US dollars can make it more difficult to export goods globally. Okay, cool. So when we're talking about this, the US dollar was being valued more as we were saying that it was going to cost other countries more money to ship into our country. We're not going to talk about the 10-year yield because we don't play with that. But here's this. This gets interesting. It says lumber and oil spiked and then fell off. Well, guys, we're in real estate. So two things that's really important is we need lumber to build houses. And how does the lumber get to us? Well, by things powered by oil. Right. So when we're thinking about this, and just like anything else, your eggs, your insert, whatever commodity here, most of it gets shipped here and it's not by a stork. And so it is oil powered. So as we're going to go through and we're looking at this, lumber and oil went up, and there was, a little bit of concern here, right? When we're talking about this, we're talking about new builds, and we're thinking about, okay, so now with these prices going up, the cost of new builds will be going up as well, right? Because it's going to cost more money for lumber, and it's also going to cost more money to get the lumber here. So if they're tariffing, because most of our lumber comes from Canada, and if we're tariffing Canada and Canada decides they're going to start putting tariffs back on us, and one of our biggest imports, especially in the real estate business, is lumber to build houses. And then it also costs more money to get them down here because oil was going up. Like this could have played a pretty impactful role in what it was going to cost actually for new builds. But what was interesting was mortgage rates stayed flat. Mortgage rates did not, and I believe have not moved at this point. Of everything that was happening, mortgage rates stayed flat. And I get that there's no direct correlation with really any of this stuff. In the grand scheme of things, while we know that there is some correlations when we see some things move, we do see interest rates move. But mortgage rates didn't move. And it says, despite the numerous headlines last week and today, and this again was yesterday, mortgage rates have remained largely unchanged. And he talks about that in the market tracker. And so today's economic data was also positive. Both manufacturing and GDP numbers were solid. Again, yesterday numbers. However, the ongoing discussions about the trade war overshadow these economic indicators. And so if you guys are following the news around these other countries, like there is some frustrations because, I mean, while the current administration is out there and saying that they are going to use tariffs to put deals together, because that's what the thought process is. This is what happened 2 terms ago. And now it's happening again is, hey, we're going to tariff you unless you do some of the things that we need you to do. And no one thought this one was a bluff. And it actually came down to where it did get put on a 30-day hold for anyone that's paying attention, right? So both Mexico and Canada, both on 30-day holds as of yesterday. I haven't really looked at the news today. And what that is that there was, troops sent to both borders to watch the border. And we don't know what March looks like. So we're going to keep kind of watching this. But what we also know is that some deals fell through. And what's also going to happen is that there's also things that we import that if they start getting tariffed back, we could see prices go up on certain things. We're going to just watch this. It's going to be interesting to see how it kind of plays out. Yes, we could see some prices go up on some certain items. And when we're talking about our business, we deal with the most expensive price tag item in the United States. And so we will have some impact on us. But let's shift it over. Let's go all the way back to Friday now. It's kind of interesting. Like the headline is pretty much the same, right? Mortgage rates stay calm before possible tariff. And the headline before was mortgage rates remain flat despite tariff drama. So this was Monday. This is Friday. So we're looking at this. Again, this is rear view facing data. It says last week, and again, rear view facing data. Last week, the housing data demonstrated stability, even as we could approach potential tariff enforcements. Mortgage rates have remained largely unchanged, and there has been a slight decrease in housing inventory. Furthermore, pending contracts reflected a modest year-over-year decline, while purchase application data remained flat week over week. Guys, we're going to look at interest rates. This, and I've been telling you for the last year that people are not going out and getting mortgages because of where they are. They're not going out and getting a mortgage, and I know that's not right, but they're not going out and getting a mortgage because they don't know what it's going to look like 30, 60, 90 days from now, and there's so much instability. But we just saw a week of time, and we're going to look at it. We just saw a week of time where they largely stayed flat. And I'm telling you that the public, while they might not like interest rates where they are, as long as they're not going up and down like a third world country, like what we'd expect from a third world country, and they know what it's going to cost them to borrow money in America 7 days from now, 30 days from now, 60 and 90, and they can actually predict it because of how flat and how stable it is, we will see more people raise their hand this year. And I'm telling you guys, like, that is going to be the story this year. Not mortgage rates dropped and there was a frenzy. We're going to see more people buying houses because of how flat and how stable it was, the cost of money this year. So again, we're not going to talk about the 10-year yield. We're not going to touch that. We're not going to talk about mortgage spreads. Purchase application data. So 2 positive readings, 1 flat reading. Guys, this is good news, right? So what we're looking at, again, is we're looking at 3 data points because we're through the holidays, right? We don't like to go through and look at what's happening Thanksgiving, Christmas, New Year's, right? Any holiday in during that time, people are hibernating. And so here we are. So we're looking at this thing, and this is where we were. We were in the basement. Look at this. Like, we were in the basement, and then we popped our head out. We kind of stayed flat a little bit right around here. So as we're going through, remember, we just went through an election. There was some instability, tariff talk, all kinds of threat. People were a little bit nervous. Yet, again, we'll talk about interest rates, but guys, here's the thing. We're looking at this data, and it says as we begin the new year, we had some mild positive trends. Cool. Like, we like to see that. And again, like, these aren't earth shattering. Like, we would all love to be up in 2023. We'd all love to be in 2021 right now, at least for making money's sake. And it says, but there was a decline of 4% year over year. Okay, so we're a little bit down. Historically, when mortgage rates are high, the purchase application data trends to reflect negative trends. For instance, last year, purchase application data showed 14 negative readings, 2 positive readings, and 2 flat. When mortgage rates dropped between the range of 6, 7.5, and 7.5. Guys, that's where we are right now. We are north of 7%. And yet we're still seeing people raise their hand. That's going to be the story this year. And that's why I'm calling it right now. The story is we were flat and we saw more people start raising their hands because they were able to predict what the cost of money was going to look like. Keep in mind, most sellers become buyers. So for a seller to go and say, hey, we're going to walk away from our 3% interest rate, they want to make sure that their money is going to go into a bigger home, a better home that suits their lifestyle versus having to sell their house, interest rates spike up. And then when they find their home, because remember, homes are sitting on the market longer, that they will be in a lesser home because they can't afford the home after they just sold the home that met their needs. So we're looking at this thing. Let's look at pending sales. Here we are. We're right in between 2023 and 2024. Again, we're not going to compete with 2022. 2022 right now is going to be impossible to compete with because, again, interest rates didn't start going up until halfway through the year. So this was still historically low interest rates. And so the pending contract data, even though the inventory data would have been a little bit less because homes were coming off the market so quickly, we're not going to really be able to compete with this number. Again, it was super weird. But here, elevated interest rates, and we're right in the mix. As I'm looking at these two things, right, as I'm looking at purchase application data, as well as pending home data, 2% less single family homes in contract than last year. Okay. And were these any of your clients that you were not aware of? Who in your ecosystem has gone and talked to the lender and you haven't been informed? Also, who in your database, who in your ecosystem went out is under contract that you're unaware that they went under contract? Again, I think that this year we have to get into the mindset that yes, interest rates are still elevated, and who is our motivated buyers, who are our motivated sellers, who are our motivated investors in 2025 that we need to get back into relationship with. We got to get out of this preconceived notion that money is too expensive for people to go buy and sell. People are still buying and selling. There is inventory. We just need to go out and have the conversations, educate, figure out what people's motivations are, and to have the conversations and to move the needle forward. So if we were looking at the weekly housing data, right, we're going to go through, and this is the 24th through the 31st. Inventory did fall. We saw less inventory on the market. And if we were to look at this time last year, well, inventory fell from 503 to 497. So we have more inventory. We know this. There is way more inventory now than there was in 2024. If we were to look at the all-time inventory bottom of 2024 or 2022 was 240,000. The peak of 2024 was 739,000 homes. We're not there yet. Again, seasonal. We are in a very seasonal market in the United States. We are in the state of Colorado. We are in a very seasonal industry as far as real estate agents go. So as we're looking through, here is 2015, 936,000 homes in the United States that were for sale. But here we go. Let's look at this. 2025, 28% more inventory now, guys, and we're climbing, right? Here's 2020, here's 2019. We want to continue up this chart. 2021, again, interest rates were so low that there was no inventory that was staying on the market long enough to really capture enough data. So as we're going in here, we want to see this number continue to climb. We want to head more into a balance, not necessarily a buyer's market, but we do want to be in a balanced market to where people are coming together, they're making decisions. I don't think this tanks the sales price. I don't think there's really anything outside of war that could really happen right now that would take our sales price and just absolutely tank it. And here's the thing that I think that we have to absolutely keep in mind. How much equity does most of America have in the United States right now? Right? When we're going through and we're thinking about this, and we're talking about even just prices coming down, unless you bought your home in the height of 2022 and overpaid, and then we kind of flattened out 2023, 2024, you're not going to see people that are underwater. People have equity in their home. So even if we came down a little bit, people are not underwater on their home. I want you to think about all the people that bought their home in 2013 and the amount of equity that they have. People that bought their home even in 2020 and the amount of equity that they have in their home right now. So this is very interesting as we're coming through and we're thinking about this. Like, there's still people that are going to sell, even if inventory continues to go up and prices come down a little bit. No one's truly underwater. I think we have like less than 3% of all homes nationwide are underwater. We have some of the best foreclosure data that we have ever had as a country right now, right? Because as we're looking at this thing, there are less people that are underwater and going into a short sale or to a foreclosure situation. Doesn't mean that there's not, right? Doesn't mean that there's not a person on a street that's having to foreclose on their home or that has gotten underwater. But this is what we have to think about. The people that are getting underwater that are actually in a bad place are the ones that have lost a job. They've lost a job. They can't keep up paying the bank. And now the bank is taking action because banks don't want to take action. They really don't want to at this point. And so even if someone was underwater on their home, as long as they still have a job and they're making their monthly payment, the bank's leaving them alone, right? Because the bank's getting their money. So as we're looking at this, I'm telling you, even if this were to continue to go up and prices were to come down a little bit, no one's going to be hurting. New listing data, here we are, we're right in the mix. So this is cool, right? 2025, 48,000, 24, 44,000, 23, 42,000. We constantly want to see more inventory hitting our market. Price cut percentages. We know 1/3 of all homes, historically speaking, take a price cut through the year. Here we are, 33%. Cool. Like that doesn't surprise anybody. Again, 2022, interest rates started going up. We saw price cuts started to hit. And this is just all pretty seasonal stuff. Motivated sellers start putting their home on the market springtime. The homes are sitting a little bit and they start readjusting their prices. Makes sense. So the thing, this is what we got to look up for tariff week. Well, we already looked at Monday, so we're already feel good about all this stuff happening. The tariffs did nothing, so now we're just watching jobless claims. This will get interesting, and if you guys have been on this call, you know that we do have federal government employees that have been given some ultimatums, told that they need to come into the office or take a payout and walk away. And we don't know what that's going to look like yet. So that's going to be very, very interesting. And then how many other companies start to follow suit. What they have done, I don't know if anyone listened to, again, um, the Housing Wire podcast that just came out for Monday that was recorded on Friday. Again, everything's rear view facing. And one of the things that they actually talked about was job sites and how they actually haven't seen a uptick in um, the workforce disappearing. Right, there was a lot of fears in the United States that with everything happening, that we would actually see the construction workforce start to disappear. They did say that they've actually seen some in the factory and the manufacturing pieces where that's actually happened, but they haven't seen a huge uptick in residential construction at this point. They also made the point about this is that let's say that it does start to happen, right? Let's say that there's a real fear about deportation and that we actually do see a decline in the working population for residential construction workers. They actually said that what this would probably do would actually just add time to the timeline. Obviously, if builders are making money, they're not going to stop. What they're probably going to do is instead of like a 12-month build, it's going to turn into a 15-month build. And they're just going to anticipate if they're not able to backfill some of those jobs. So it's going to be interesting. We're going to watch this, right? That's going to be the one thing that we definitely want to watch because as we do know that when we do go into these recessionary times, one of the things that we feel, because we do deal in the largest price tag item in the United States, which is real estate, that when we do go into a recession, then one of the jobs that does get hit the most is real estate. And more specifically in the real estate sector, it is actually construction workers, whether it's by the piece or they're doing by the job, right? Where we're talking about framers, we're talking about roofers, like those are the guys that actually start to feel it first. And so if we do see that population start disappearing, especially with this on top of it, that might be an indication of some other things that we're going to run into. But again, I don't think anyone foresees any of that really happening at this point. I did trip over this, which I actually thought was interesting. It says the pipeline for converting office space into apartment has surged by 484% in just 4 years. All right, cool. So let's look at this thing. And so here's 2021, 2, 3, 4, and 5. And we can see 12,100 all the way up to 70,700 US office to apartment conversion pipeline. Guys, this is where they're taking these office spaces that are largely empty and they're converting them into residential apartments, which is a huge undertaking, right? When you're looking at this thing, the biggest thing that they run into is what do you do with the interior units that don't have windows, right? Like that's probably the biggest thing that they run into. Everything else is figure outable, but it's like, okay, like how many people, show of hands, put your digital hand or, if you're on screen, put up your hand. Like how many of you guys want to live in a house that doesn't have any windows? Cool, nobody, right? Like, so that's kind of the thing that they're running into right now. And so if we look at this, none of these are in Colorado. We wouldn't expect there to really be in, but like New York, they have 8,300 office to apartment complexes in their pipeline that they're converting over right now. Washington, D.C., 6,500, LA, 4,300, Chicago. I'm actually surprised that Chicago's this low. It's not a little bit higher, but 3,600. And again, like the biggest thing that they're running into is really just windows. Like, how do we go through and take the interior of these buildings and put some kind of light? So they're actually going through. It's very, very interesting. If anyone's following any of this right now, is they're actually creating like artificial windows where it's actually like they're putting in these window spaces that are actually pretending like they're actually like pushing light through to make it look like that you don't live in a closet. So we'll kind of see how this thing plays out. Colorado, we have Denver, right? 1,300. Like that's pretty low. Michigan's interesting just because I think Michigan pretty much had a pretty big uptick and actually companies moving to Michigan because of the price point. What we actually saw was in Michigan, we saw like bankers and mortgage companies actually move over into Detroit, into downtown Detroit. So I think that's why this number is so low right now. But again, New York, DC, California, Chicago, again, I'm surprised Chicago was actually that low and not higher up on the list. But like those are our four main players. And then everyone else, like we're pretty low. So we'll kind of see what happens in Denver as we're playing this out. I'm not aware of anything right now, but I'm sure if we were to go in that area, we could see some different things happening. And it'd be interesting to kind of see what the price point on some of these look like. Let's look at our Nevada Altos data. As we always do on this call, February 4th data. So this is today. Guys, we're sitting pretty flat on a lot of these things. So median list price, we're sitting flat. Median list price of new listings, it ticked up a little bit, but yeah, not too much, right? We're going to call that flat as well. Price per square foot is going down, not truly concerned, but we always want to look at this. Average days on market and median days on market. Keep in mind, average days, we're taking all the homes on the market, we're dividing them by the total number of homes on the market, and we're getting our average. Median, we're taking the outliers, we're working our way into the middle, and that's the middle. Again, when we're sitting down at the dining room table and we're having a conversation with the seller, we need to let them know that like this is the consequence of overpricing the home on the market today, right? This isn't 2021. We have a lot of data that proves this is not 2021. And so if we overprice the home, we're going to sit on the market for 163 days. During that time, we know we're going to take a price cut because as we look at this thing, 38% of all homes in ALLL2 are taking a price cut. And on top of that, we're still making monthly payments. Homes are passing us on the market that we may have been interested in. Interest rates, who knows what they look like tomorrow? We have a lot of factors that play against us. So this is why we need to price the home correctly. When I look at this and we look at the middle priced homes, the median, 90 days. So we're going 30 days, or I'm sorry, 90 days, 3 months versus 5 months. Making monthly payments. We're paying insurance still in the rears, but it's still happening. You may have forgotten about it, but we're still paying insurance. We're paying interest. We're paying all these other things that are happening, and we're doing it for an additional 2 months. These are the conversations we need to be having. We're going through price decreases. We just talked about that 38%. We're almost in line. Nation's seeing 33%. We're at 38. Price increases. This number has gone up a little bit again. This is telling me they're doing more and more phase 2, phase 3, phase 4. Homes, new builds are selling. This is what this data is telling me, that new builds are selling and they feel comfortable raising the prices. This isn't a home fell off the market and they were like, oh, now we have the opportunity to go back on the market at a higher price. No, these aren't resales. These are new builds. So make sure that we know the new builds in the area, right? What are the incentives that they are offering? Because that's also what we're seeing. We're also seeing compensation. We're seeing big concessions at this point. I was talking with Bob earlier yesterday, and there's some builders that are offering like $50,000 in concessions. Guys, like, do you know who these builders are? Do you give them to your clients? And so that we can actually say like, hey, I get it, like the resale, maybe you don't want to go spend this money, but if we can go through and get you the updated appliance package and we get all the blinds in the house and we can get your interest rate a little bit lower and we can do insert whatever here, doesn't make sense for us to go look at this new build community, right? Like let's get back into relationship with new builds. I think there's going to be an untapped potential for you guys to do a lot of cool stuff this year. Inventory, they're giving it a score of 13. Relist, 15% it did tick up. So, okay, so we're not coming to the table and getting some of the things fixed. 15% are falling out of contract. Median rent, $3,200. They're giving it a score of 50. So we still are in a seller's market. We are a little bit better than we were back in January. And so we'll kind of just see how this thing plays out. But this is what I really wanted to bring to everyone's attention: interest rates. This is as of yesterday. This isn't today, but this is as of yesterday. See how flat this is. Again, this is only 1 week, but this is Tuesday to Tuesday, or I'm sorry, Monday to Monday. And as we're looking at this thing, guys, this is what we want to see. I don't care where they sit. All right. So if we're sitting, and again, like this is closer to prime, I would say, than anything. We're probably closer to 7% in all reality. Yet, if we're looking at this and we're living on this line, this is what our consumers can stomach. That they know what interest rates look like today and tomorrow. Remember, most sellers become buyers. And so if we're thinking about this, if we list our home today, right, and let's call it the 27th of January, if we list our home today on the 27th, we know that homes are sitting, at least in Arvada, 163 days if we price them wrong, 91 days if we price them right. Okay, so there's the first thing. So let's play this timeline out, right? So if we're going through, and let's just pretend like we hit 90 days. If this sits like this, we'll have more sellers list their home because they know what the cost of money is going to be. The biggest fear that most people have right now is if they list their home today, what is the cost of money after my home sells? Because most people don't have the money to go buy a home. They need their home to sell first. And we get down to the finish line, and can I still afford a home? Does it still make sense? So let's look at 1 month. Still not too terrible. We do see some blips, but we're still staying pretty flat. But I see how this could, get in some people's heads right here. 3 months, I think this is what demonstrates it, right? Like while we did come pretty flat from where we were day 1 to day 90, this is the kind of stuff that kind of worries some people, right? 6 months, this is the stuff that really worries people, right? Like we started down here. If I were to list my house and I was thinking I was going to get 6% rate, and then I'm locking in at 6.5, what does that do to my purchase power? So we all need to be getting to the point, right? And we look at a year, 2 years, right? This is not the United States. Like this is scary, right? When we're looking at this thing, we're coming from as a consumer, someone that has to list their house, to sell it, to be able to afford a different house, and what are the rates going to look like when I actually lock my rate in after I get my home sold. This is what's deterring some people. So this is a little bit better. And again, this 1 week data, if we can kind of live more so like this, I can guarantee you guys, even at 6.8 and 6.5, you're going to see more people raise their hand. It's not interest rate driven. It's the instability that we have around interest rates right now that are actually deterring more people.